Stick with the most powerful of all bars on your daily, go inside of them, and then use 55% retracement events. John, that's very important. I know. All right. Okay, let's talk about the 200 period moving average here. Okay? The 200 period moving average. The 200 period moving average, if the 8 and 20 are the most powerful when they're trending, the 200 is the most powerful when it's flat or flat-like or flat-ish. Okay? A flat 200 period moving average is powerful. It's powerful as support if the stock is above it. It's powerful as resistance or a ceiling if the stock is below the 200, the flat 200. So when stocks are above a flat 200, the 200 period moving average will often serve as a solid floor of support. If the stock is under the 200 and the 200 is flat above it, it will take a lot for the stock to penetrate back through the 200. That 200 will often serve as a granite-like ceiling that will prevent the stock from getting through. And once again, if stocks get way too far above or below the 200, there's a callback feature there as well. Now look, let's take a look at a few examples. Rick is saying, what if the overall market changes 55%? All right, so let's say the market's bar was solid green, and now you've lost more than 55% or more of its green, the green bar. Now you start, let's say you were playing long, and you even still have some longs. Now start adding shorts to your game. Guys, a lot of these things we do cover in more detail in the 5-day portion. All right, because we live through those very scenarios. Okay? So now you start adding shorts to your game. All right, whereas that when it was solid green, you were exclusively a long bull. Once you lost the bull, continue to manage your longs because you're already committed, but now add some shorts to your portfolio. Make sense? All right, Jonathan, what doesn't make sense to you? Very quickly, you got to be quick for me, though. What doesn't make sense? Adding shorts in a bear, if the market goes bearish, doesn't make sense. How does that not make sense? Market was bullish. You were a bull. Now the market goes bearish. Add shorts. What doesn't make sense? Should we be playing more than one stock at a time? You better be, Jonathan. And in a scenario like that, you better move to the point where you play more than one stock at a time. How are you going to become a big player? Being a onesie stock player. Think of a mutual fund that would buy one stock. Would you put money in a mutual fund who bought one stock? I wouldn't. I wouldn't. Well, you've never seen me train you on two stocks at a time? Are you a retake, Jonathan? Jonathan, are you a retake? All right, now, flat. Look at what's happened here. I want you to show you what's happened here. We have a flattish 20. You've got a stock that is below the 20, then above the 20, then below the 20, then back above the 20. It runs back through the 20, gets halted at the flat 200. Then we pull back. Then the stock gets halted at the 20. The 20 stops the next decline. This halt tells us the next trend is up. Bam. That initial halt. Now here we crack back through the 20, and the next area of support is the flat 200. Then we buoy off the flat 200, back up. We pull all the way back through the 20 again, and we find support at the 200 again. So the 200, when it's flat, does tend to serve as a strong area of support and resistance. Right? Just showing examples of how the 200 acts when it's flat. All right. Look at this scenario. Stock rallies right up to toward its flattish 200 period moving average. What kind of bar is this? What number would you say that is? So we need the whole bar's low to be taken out, right? The low is taken out there. What are you doing? Right there. If the daily bar is red, of course. What are you doing? Right. But you had better make sure the daily bar of this stock is some form of bearish bar. You got it? If the daily bar is bearish, you can take this short. Right past that. Oliver, I see, but you went right past a downside halt. Capture at around 15. Are we? Oh, the prior picture. Let me see. Rallied to the 20, got halted here, dropped. Right now, this could have entered into an extended downtrend. But that halt then got reversed and it went right back up. That will happen a percentage of the time. Nothing's going to happen 100%. So now we're back into the crisscross range, right? Now this is your next halt. So now this tells us, okay, well now maybe the move is up to the upside. Absolutely. Okay, if your daily bar is bearish, you can take this short. Absolutely. If the daily bar is bullish, that is not a play that you take. Now, guys, I want you to understand, let's assume the daily bar is red, okay? And here's your scenario. There are three things that create the odds that there's going to be a sharp decline from here. The three things are, listen to me, the three things are, the daily trend is down, right? That's reason number one, there should be a drop. Reason number two, you're right at an overhead flat 200 on the 2-minute. Reason number three, what is it? From the 20, yes. Reason number one, daily trend is down. Reason number two, you're up against the powerful resistance at the flat 200. Reason number three, Dante has gotten a little too far ahead of its master. The stock has gotten a little too far above its 20. So here you have the 200 wants to push the stock down. The 20 wants to pull the stock down. So while the 20 is pulling, at the same time the 200 is pushing. Does this make sense? Now, Gene, I know you're bringing in other concepts here, Gene, with the whole engulfing thing. You didn't have an engulfing bar before. You didn't have an engulfing bar there, did you? Was there an engulfing bar yet? That's still bearish. Leave these concepts out, please. This is a bearish scenario right there. Right now I'm saying, wow, if this low gets violated, I'm in there. Before that, I'm in right now. Uh-oh. Let me do that. Right here. I'm in. I'm right there. I'm in the stock. Right? My stop is above this bar that I just entered. I'm in. Okay, now, here. Two things again tell me this stock at 27.80 should decline. Two things. Number one, it is extended far above the 20. At the same time, it's bumping its head up against a flat 200. Since these green bars here are tiny, I need a 100% event to happen. I get it on this first red bar. This first red bar violates or breaks the low of one of those little green bars. I've got my 100% trigger, enter, and there's my collapse. I can only take this short if my daily bar is bearish. Don't ever forget that. These all assume that the daily bar gives you the right to take this short. Okay? Yeah, that's very true. When you're playing off the 200, your 20 will always be opposing your play. It has to, otherwise it wouldn't be near the 200. All right? So yes, remember I told you that's a general guideline. There are appropriate times to go against the 20, and I do explain a little more of that tomorrow. When is it appropriate to trade against the 20? Well, one of the times is if you're up against a flat 200. Another time, as I'll explain it tomorrow. A lot of these things are going to become clearer, I promise you. Okay. Stock rallies comes up against its flattish 200 period moving average. It's also way above the 20. You can take this short, provided the daily bar is bearish. So at or near a flat 200, you can take a 55% or 100% entry event as long as it's in sync with the daily bar. And the moves off of the 200 tend to be very, very powerful. All right? You can keep walking it down, Tim, if you like. Yes, also prior resistance. That's absolutely right. Now notice whenever you swing a little too far above the 20 or a little too far below, you snap back, or once again a little too far above. See, these wide spaces, the stock doesn't stay there, right? You can see that. Oh, we swung a little bit too far this way. Boom. We swung a little bit too far the other way now. Boom, rally. Now we swung a little bit too far the other way. Bam. But you only take the swings that are in sync with the daily. You leave the opposing swings alone. If you want to live an easier life as a trader, you trade with the daily bar. Most of the time, you trade also with the 20-period moving average on your micro time frame, except with flat 200-period moving average plays and climactic plays, which I talk about tomorrow. You can play off of flat 20s if you're getting the first halt or capture. If you're getting the first halt or capture. Is this all making sense? Is this making sense, guys? All right. Let me repeat it one more time. If you want an easier life as a trader, trade with the daily bar. Most of the time, right, when trading on your micro time frames, you're going to be trading with your 20-period moving average. The times that you are allowed to trade without a trending 20 is, or an opposing 20, you can take a play at a flat 200 in sync with the daily, irrespective of what the 20 is doing, and you can take climactics against the 20, which we talk about tomorrow. That's another tactic tomorrow, climactics. And you can take plays off of a relatively flat 20 if it represents the first halt scheme or scenario I explained to you. All right, so those are the scenarios. Now, someone was asking what the entry is. Okay, the entry could have been, well, that's not quite 55. Here's your entry. $55 retracement of a regular size green bar or a 100% retracement of a neutral bar. This bar, I would say, represents a neutral bar. We cracked the low. All right. Now, here's my question to see if you really got this. Your daily bar on this stock looks like your daily bar looks like that. Give me the approximate entry price of your most recent play. an unfair question. But some of my retakers will get it. Yeah. Right here, right? What, 1985 or so? Now that's a little unfair because it involves a tactic we cover tomorrow called the climactic. Far away from the 20, all right? It's a counter trend. It's a counter micro trend play in sync with the daily bar. We cover that tomorrow. But good job, retakers. Most of you got it. Yes, that's right, Mel. Okay. Now, guys, wait a minute. Let's say you won't do this with my account for a while. But let's say you're using the flat 20 MA concept to play longer plays that you hold for multiple days and sometimes weeks. All right? So you're using the daily chart. You're going to enter off the daily. You're going to use, you see that the stock has rallied up on the daily back to a flattish like 20 MA. Where is your entry price approximately on this play? Where's your entry? Now, if you're up against a flat 200, first of all, are you a bull or a bear? You're a bear, right? You're a bear. All right, so if you're a bear, you're going to pick a short point. Where's your, once again, give me your approximate entry price. I see some good answers. I like it. Okay, anyone who came in around here, 1825 to 1840, I'll take. 1820 to 1840, I'll take. 1820 to 1840, I'll take it. Now, if you don't see why this is your entry price on the short, I want you to look at it carefully before I demonstrate it for you. That's right, Abrar. Excellent. That's right, retracement of a small green bar. So let me show you what happened. Look carefully now. Remember, none of this existed, right? Watch carefully now. Watch me carefully. What happened here was after this bar rallied, the stock gapped. And then rallied to almost kiss the 200. So at the high, it's a solid green bar, right? Now that bar is still trading. The day, this is a daily bar. This day is not finished yet. Somewhere throughout the day, all of this green disappears. That's a 100% wipeout of green. What are you doing right now? You're shorting right here, right now. You got that? Maybe it wasn't enough green to do a 55, but all of it got erased. Where's your stop? 1 penny above the high. Excellent. And if you held, you got rewarded nicely. Beautiful. All right. Okay. Follow me here for a moment. You're above. First of all, is this a violation of the 200? Is that a break of the 200? Okay. Excellent. No, it's not 2 bars. It's only 1 bar. It's a 1 bar poke. It's not a break. In order for it to be a break, you have to have another bar take out the high of the poke through bar. We don't have that. That's a lean. Okay. Now, we drop. We're below the 20. Then we're above the 20. We're bumping. The stock is bumping its head up against this 200. It drops back below the 20. The 20 is flat now. It's sleeping. Rallies back above the 20, bumps its head up against the 200 again. Below the 20, above the 20, bumps its head up against the 200 again. Below the 20, rally can't get back through the 20. Now, I know this is at the end of the day. Let's assume that it's not at the end of the day. What is the next trend, up or down? Okay, that's got to be your assumption. Will you be right every time? No. 80% of the time or more, your next trend is down. Why? The 20 halted the stock, preventing another cross, telling you that now the 20 is a bear. It was sleeping first. It's woken up on the bear side of the bed. It's going to now pull the stock in. Okay. All right. Stock rallies through the 20, bumps its head up against the flat 200, drops back through the 20, rallies back above the 20, bumps its head up against the 200, pulls back, does not penetrate the 20 on the pullback, buoys back up to the 200, pulls back, does not penetrate the 20. What's the next move? Up big or down big? Up. That's right. Excellent. The 20 is now halting the pullbacks, telling us that a blast through is imminent. Okay, beautiful. Yes, it has to be consecutive, Frank. Good question. The violation of a moving average requires 2 bars. They must be consecutive. If they are not consecutive, the next bar that pokes through becomes bar number 1 again. Now, let's talk about the gift. As there's a scenario, right? There's a scenario that I call the gift. The gift is when you have bar 1. This is bar number 1, right? Almost entirely all green. When bar number 1 is the first move up, you see there were not 5 other green bars before this big green bar. Bar number 1 was the first move up, okay? Or close to the first move. It doesn't have to actually be the first bar up, but it's got to be in the beginning of a move up. So bar number one kind of ignites the advance. When you have bar number one that is starting an advance, any pullback into the bar's range, the green part's range. This is the green part of the bar. Now here's the range of the green bar. See? Any drop back into the green range is the gift. Now, meaning that you must buy this drop once you get a 55 or 100% retracement. Now, in the gift scenarios, 55% violations don't count. The pullback can violate the 55% level and still be bullish with the gift. So, why do I call it the gift? Because the market is handing you a second opportunity to jump on board this stock. This first bar tells you big, giant buying elephants just jumped into the tub. They put their first giant, I don't know, what is an elephant's paw? Is it a hoof? Whatever it is, they put that big, giant foot of theirs in the tub, but only the first foot. Only the first foot, right? It's big. They didn't get their whole fat body in there yet, though. So the stock pulls back, and the pullback gives this elephant a chance to put the second foot in. Boom! And we want to jump on board when the elephant puts the second foot in. You see, this is the first foot. All right, that's the first one. But there's another shoe that's going to drop, guys. Here's the second shoe that dropped. Boom! All right? Now, they put their tube, then they ease in a little bit. So here's where they're easing in. See, they're easing in here, easing in there. So now the stock's going to start trending, and then they do it easier. But they initially start out, boom, first foot, boom, second foot, and it starts getting easier a lot. So that pullback after the first shoe drops, any pullback into a wide range bar number one is the gift right before the second shoe, the second big giant hoof or foot or whatever it is. All right, now, you can only, guys, listen, you can only take gifts in the direction of the daily bar. All right? Can't violate that rule. Now, do you see where you would have entered the gift? Do you see that this is your entry bar? Do you see it? Okay, look. This bar looks like this at the low, right? You stalked it. You said, oh, look, first red bar. Oh, I'm getting the gift. All right, no entry yet. Waiting for a 55% event. Here's another red bar. Oh, the gift. You're salivating now. All right, no entry, no 55%. Then another little red bar. Okay. All right, got a little retracement, but not a 55%er. Here's another red bar. Now your hands are all wet. The saliva has dripped all over your fingers. But you don't move your fingers off that buy button. All right? You're going to wipe them down after you get in. Now, what happens? Retrace a little bit. Uh-oh. Uh-oh, it might be here. It's coming. Get ready. Retrace a little bit more. Uh-oh, get ready, get ready. Boom, 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 bam! enter, stop under the low. Now, you've bought already, right? What are you doing now? Get in again. You got the 55 and the 100 on the same bar. You bought it twice. And look at your reward. Now, on a micro time frame, this is only, let's say you bought it, the first one at 25.08 and the second one at 25.10. All right? So your average price is 25.09. Okay? You moved up to the flat 200. You know, hey, look, this stock's not getting past Big Brother up there. So I'm getting out near the 200. So let's say you got out at 25.31. Okay, or 25.32. Let's call it 25.32 or so. All right, it's fair enough. Okay, so basically you got 23 cents move. But let's say that was on, I don't know, 5,000 shares. How much did you make? $0.23, 5,000 shares. All right, so you made, let's say you made $1,200 bucks. All right, you made $1,200 bucks. How many minutes? Not bad for 6 minutes of work, huh? Explain it. Okay, you bought here. Bought there. Here's 2 minutes. 4 minutes. My mouse not working. 2 minutes. 4 minutes. Out. Probably less than 6 minutes. Yeah, I know. I know. But remember I told you, I will teach you what plays, I will teach you how to play the first hour before you bring the daily into play. Please take your gifts whenever they occur. Because in the gift, guys, in the gift, doesn't the first bar serve as the daily? Aha. Does that make sense? The first bar gives you your direction, doesn't it? You see how this stuff really kind of makes sense, right? When you think about it, the first bar of a gift is your daily. It tells you, get in on the next pullback. You follow what I'm saying? So the first bar of a gift is like your daily. It tells you, go that way, wait for an opportunity, but take it in the direction of the first bar. Okay? Yes. In the 1 minute, the 55% might occur earlier. Yes, but let's say if on the 1 minute it occurred earlier, maybe the 1 minute 55 was also at your 55% of your 2 minute. It's hard to say. We don't know how the 1 minute formed. Okay. Now, guys, let's talk about law number 1 was the follow-through law, the law of momentum. Solid bars tend to spill over into the next bar. There tends to be follow-through on powerful bars. 80% of the time. Market law number 2 was the law of 2, that nothing really great in the market is ever achieved with 1 bar. It always requires, it's a 2-bar event. So breaks of anything are really firm only after 2 bars, not after 1 bar. Now, law number 3 states, law number 3 is the 358 bar max law. Okay? I know that's like a cumbersome title, but the 358 bar max. Now, I'm going to try to draw a diagram here. Let me try to draw a diagram. What this law says, after I explain the law, what this law says is that stocks have a tendency to operate in a in a swinging fashion, 3 to 5 or 3 to 8 bar max swings. So I want you to imagine this. Stocks will tend to be able to produce 3 of one color in a row with ease. The turn or the reversal of a color, of a single color run, will tend to happen right between 3 and 5. So after 3 green bars in a row, you're likely to get a red bar occur, or the end of that 3 green bar run will tend to occur somewhere between 3 and 5. Every now and then, you can get a single color run that moves into the next gap. This is gap 1. You can get a swing that moves into the 5 to 8 bar category. Rarely will you ever see a single color run move more than 8 bars in a row. Rarely will you ever see more than 8 green bars in a row. Rarely will you ever see more than 8 red bars in a row. Usually you get an interruption or a change of color between 3 and 5. Every now and then you can move between 5 and 8. Rarely will you see follow through beyond 8 bars in a row. So when I tell you that Rule 1 says, solid green bar, 80% chance the next bar is going to be green. Solid green bar number 2, 80% chance the next bar is going to be green. Solid green bar 3, 80% chance the next bar is going to be green. After 3 greens in a row, things start to slightly change a little bit. After 5 in a row, the odds are not the same. After the market has shot 5 bullish bullets in a row and given you 5 strong bullish bars, it's spent a little bit. It's a little tired, so you don't have the 80% chance of follow-through after 5. It starts to diminish. If you happen to get 8 bullish bars in a row, now it's the reverse. There's an 80% chance that you now get a reverse move. So I would say 5 is when you begin to lose a chunk of your odds. 8 is when all the odds of follow-through are gone. Does this make sense? There's that question again. Is this applicable to just 1 minute, 2 minute, 5 minute? Ask it as many times as you want, whatever it takes to drill it in, every time frame. Your soap lines don't make a difference. Every single one. This applies to. All right? Will you ever see, will you ever be able to show me more than 8 green bars in a row or more than 8 red bars? Of course you will. But I bet you don't show them to me frequently. It'll be one period where you might be able to show them to me because the market gets one-directional, crazy in a one-directional way. But it'll then, for a year, you won't be able to find another period for another year. It's that infrequent. It just doesn't happen. The market operates in this 3 to 5 or 3 to 8 bar max swing zone